Thank you, Saurabh. Thank you all for giving us an opportunity to participate in this conference. Thank you, JP Morgan, for arranging this. We have Srini, our CFO, Ajit, our Head of Investor Relations, and myself out here. We'll just give you a quick run as to what's happening in the environment at this juncture, and we'll open it for questions. First of all, thank you very much from the investor fraternity for all the good wishes that is poured in from all corners for me. It is a big shoes to fill. It is something that, fortunately, I think we have a great management team, a wonderful platform, which we are inheriting what Mr. Puri has created. And I think a combination of the platform, the great the management team, a lot of energy in them, and the fact that our brand, our capital positioning, our asset quality, our distribution, all that is very much very buoyant and hungry. I think we have a reasonable confidence of carrying on the legacy that Mr. Puri leaves behind. India is a great destination, so the market opportunity is extremely wonderful, and we believe we can be at the forefront in nibbling away that opportunity without compromising on our risk and ethics standards. So that's number one. Number two, the job is even more easier because I don't have to think about new strategies. The strategies that we wanted for the bank over the next 5 to 6 years were all planned about 2 to 3 years ago. All the strategies are no more a bird in the sky. No, all the strategies have been implemented. I think the team and I will just have to now press the pedal to gain scale over the next 3-5 years so that we are able to nibble away this kind of a share, if not faster than what we have done in the past. I'm sure a lot of you probably would know what are the key areas that we are focusing on. We probably may be just reprioritizing it from now on. One of the most important things that we are focusing on is on the tech platforms. We realize that going forward, you could have a blurring of competition between banks and platform players. So we need to have our tech architecture should be as seamless and frictionless as what platform players will be offering. So we are having a lot of ideas and a lot of thoughts and a lot of plans which will get fructified over the next 6 to 9 months, some of which I'll spell it out. One is that we are trying to have a parallel stack which will be a fused architecture so that the journeys can be even more frictionless and straight through without too many hops. So that will give a wow experience for the customer. We should be finalizing the plans and probably announcing it shortly. It will take about 6 to 9 months, or even at the worst, maybe a 12-month window for that architecture to be up and running. This is going to be very important in our journey in the future. The second is we, by virtue of our dominance in all the segments that we have been participating across retail, across SME, across wholesale, we believe that we can be at the center of creating ecosystems. I've been talking about this in the past, and I think now we have started off some of the journeys, and these are very important from a future perspective because we'll be creating banks within the bank. Some of the ecosystems that we are trying to create, very similar to what Ping An has done in China on the health ecosystem, we are trying to do the same out here in India as well. Because we have all the segments where we are reasonably dominant, whether it is the doctor segment, whether it's the hospital segment, whether it is the the pharmacies, whether it's the diagnostic centers, whether it's the healthcare insurance, whether it is the pharmaceutical companies, the stockists and the distributors. So we have all of that, both from a B2B and a B2C perspective, all the ingredients there. All that we're trying to do is we are going to stitch all these things together so that from a customer perspective, when he wants to think about anything about medical care, he thinks about HDFC Bank. So we come in the center for all the payment needs and all the funding or the loan needs that the customer may have. Now, by virtue of of this, the customer will have the ability to choose under one umbrella whatever he needs from a medical care perspective. So that's the objective. And by virtue of that, even the B2B, that the stockists, the pharmaceutical companies, we are planning to link the supply chain for inventory management and ordering as well. So this is a part which we have launched. We will be sort of announcing the first element of that, of an alliance partnership with one of the largest hospitals. So that is something that we'll be doing now shortly. And all these journeys will take about maybe a year or two before you can have the entire gamut of experience and the benefits arising or accruing out of that. Similarly, we have embarked on the creating an auto ecosystem, i.e., we are the market leaders on the retail distribution of auto loans. We are the leaders in the auto insurance. We have a fair amount of relationship with dealerships and also with OEM manufacturers and also the service centers and the tire manufacturers, etc. So when I say auto, it means both two-wheelers, four-wheelers, commercial vehicles, tractors, etc. So any person who has anything to do with auto, whether it's for purchase, whether it's for valuation, whether it's for sale or exchange, or for a test drive, or for booking of for servicing, whatever that is, we'll be at the center for both payments and, if required, even from a funding perspective. So when a customer wants to think about anything to do in the auto world, we will be there. We want to sort of use that ecosystem. So like this, we are going to embark on other ecosystems as well, such as the trade and merchant, because as you know, we already have a large merchant footprint of 2 million merchant footprints. The fact that the pandemic we just consolidated, we haven't ramped up from there, but now things are opening up, so we will continue our journey of ramping up. As you know, we have a vision of doubling where we are in a shorter span of time. But we are going to use this opportunity to link the supply chain of the merchants with the with FMCG companies and multiple other things. So we are, linking and deep linking it with all of that. This is a lot of hard work in it, and we believe that is the best way to going forward, because you do a lot of hard work, which is it'll be difficult for competition to replicate. So we are quite excited about the things that we are doing and what we have, the plans in Analysts. We will keep on updating as to where we stand and how that's progressing. By virtue of this, I think what we are trying to do is we are trying to create a bank within a bank. So even in our existing infrastructure stack, we are now trying to make it even more seamless. We are partnering with the likes of Adobe, etc., which we will be launching. So we are recreating the journeys that it's even more frictionless, because ultimately the future is all about how I am able to wow the customers with the journeys. We have done a fair amount of work over the last 5-6 years in creating wonderful journeys for existing customers, but we need to really step it up to create even more frictionless journeys, reduce the number of touch points, reduce the number of hops, and create more, and also create improved and journeys for the new-to-bank customers as well. Since we're now talking about new-to-bank customers, to be able to provide an equally frictionless experience for the new-to-bank segment, we need to then have the ability to have a lot of information on the fly and the ability for a decision-making capability to be even faster, to be able to assimilate the kind of information much quicker without compromising on our models. So we have embarked about 2 years ago on creating a very robust AI platform. That platform, we had about a couple of use cases, which was very successful. Now we will be riding on this platform to even add a lot more use cases, including in the credit decisioning itself. Mind you, the decision models and algorithms will be with the bank. We're just starting to see how we can come out with sharper models and a faster turnaround of models and decision-making ability, so that not only will we benefit from the non-pre-approved of existing customers, but even the new-to-bank customers. This is going to be a very important element of our strategy, because this will help us go out into the market in edge banking, which is where we have a lot of experiments going on. As you know, we had embarked on some of the plans wherein we are now integrating our APIs with multiple such partners. A lot of experiments are on. I think at the right time, probably we will unveil what is working, what is not working, what are we planning to scale that up. So a lot of things are on the anvil on the tech side and the digitization side. Our plate is full, but we're quite excited about what's in store for us going forward. So that's part one. Part two is on the other strategies, on the semi-urban and rural strategies, that, when you look at these times of adversity, it's quite clear that the rural India is on a different track as against urban India. I'm not saying that rural India is not impacted by the virus. It has, but to a much lesser extent, and probably concentrated because of the reverse migration in some of the states. But largely, good monsoons and the current trends of what's happening on the harvest, I think the rural Indian economy is going to be is going to be a saving grace for the overall economy. It's still small, but at least if you really see the numbers, that's the only number which is positive even as we speak in the GDP growth. So the harvest as we speak, the way the numbers are coming in or the news is coming in, is going to be reasonably much more than what we have ever seen in the past. I think this is good news for us. So we have seen, and which is also evident from the kind of products that is being sold. I mean, our two-wheeler sales, the tractor sales that has happened over the last 3 months, we've got an all-time high thanks to the rural economy doing much, much better than the urban economy. We've also seen a bump up in the small cars, but that's something that is evident both in the urban and rural markets as well. The fourth one, which has done well, is the gold loans. Obviously, people realize that availability of credit, especially to non-salary segment, is something that is not going to be so easy other than the people who have got eligibility under the government guarantee scheme. So I think a lot more people have resorted to pledging their gold. So we have and I'm sure the system has also benefited from a larger sales of the gold loans. As we speak, rural India is surely, quite encouraging, and that is where our distribution expansion is slated to be. Our CSE, which was, a bit quiet during the pandemic period, only the business correspondents were very active because they could do the transactions, but the business facilitators probably had a weaker time or a more tepid time during the pandemic because our policies were a bit tight on that channel sourcing. But now I think with the kind of comfort our credit teams have got on the rural economy, I think we have now started to see the pickup in the business facilitators and the CSC channel. So as you recall, we have roughly about 100,000 CACs who open accounts with us. We have today about 6,000 odd CACs who are banking correspondents. We are going to ramp it up to about 25,000, which we should have done by June, but thanks to pandemic, maybe we'll do it by March. The business facilitators have started to source liability accounts and some of the asset accounts. I think we should see at least 2 to 3 products from this stable of at least a minimum of 75,000 odd active CACs over the next 6 months. I think that will be a wonderful run rate when we start to touch about 100,000 to 200,000 products a month from this particular fraternity. We had to sort of slow down some of the incremental branches, but I think with the workers coming back, we should start to see new branches also opening up both in urban and rural parts of the country. We have, as I said, retail assets is going to be a big driver, but it's only now that we will see. I mean, come October to December with the festive treat, then we will probably see whether we are able to sort of trigger that kind of activity in rural economy. The third aspect is on the virtual relationship management team. They have been incapacitated over the last 6 months because we did not allow them to come to the main centers. We only allowed a third of the people to come there. But the balance 2/3, we asked them to work from home. We had all the elements of, we sort of provided all the virtual connections to the systems with all the security features, so they could do that. Frankly, we were very surprised by the level of productivity that we could see despite the fact that they were not working from their centralized centers. But they could have a seamless experience of going through the call centers from home. So we have seen productivity move up, and I think we are almost on the throes of reaching the pre-COVID levels as we speak in terms of productivity and income levels as we had envisaged at the time of pre-COVID. Again, for the benefit of all, this is going to be a game changer and a big strategy for us. Today we have 3,500 VRMs managing about 6 million customers. We plan to take it up to about 20 to 30 million customers over a period of 2 to 3 years. We realize the more you engage, that's where you will get engagement, you will get reciprocity from the customers, and that's a very simple philosophy, and that is exactly what we want to do. We want to ensure that the journeys are as seamless as possible from there. To enable better customer experience, we are embarking on an omni-channel customer experience hub, a state-of-the-art customer experience. So, as this is a part of the digitization and the new technology that we are investing in, we have never invested in both inbound and outbound customer experience or call centers, as they call it. But now We are planning to use this not even to the call, but even to call centers or the VRM channel, but also to the branch channel. So we will have probably the entire channels having one view of the customer of all the interactions across multiple channels so that you have an omni-channel experience. This is going to be a game changer because this is going to be riding on AI platforms and a lot of bots to help in improving efficiencies. This is something that we will be launching shortly. This will probably be a 6 to 8 month project. So a lot of things should come about in the next 6 to 9 months in terms of where we as a bank would be having a differentiated outlook and offerings both from a customer perspective. The fourth one is on the payments. I've just spoken about it. We are not only going to ramp up our merchants now that the things are opening up, we are also planning to create, push up the smaller merchants or the Kirana stores in the semi-urban and rural parts of the country. That is our forte because we are present there, and providing the kind of supply chain with various corporations, the best of FMCG companies in the country who are supplying to these stores across the country. This is going to be a big game changer for us because we will be linking almost a huge amount of the small merchants with FMCG companies and the supply chain of stockists and distributors, etc. So the trade and merchant ecosystem and the fact that we're going to ramp up the merchant footprint, I think, is going to be a space to watch, and this is going to be a growth engine for us for the future. Branch channel is something that we're extremely proud of how they reimagined themselves, but that's just tip of the iceberg. We have a lot more to do there in terms of providing efficiency and a lot of other efficient tools to the front-end staff. One aspect of it I've spoken in terms of providing the customer experience hub, which will be common to both all the inbound and outbound call centers and the branch, which is going to be a game changer. In addition to that, the people at the front end, where 60% of my workforce is there, will be given a kind of a tool which they should be very extremely happy to do so. So this is something that is going to be a key driver of our strategy because in the first wave of efficiencies or reimagination that we did for the branch banking, we could sort of double up our customer acquisition from 3 million to 6 million last year. I think when we go into the next wave of digitization in terms of giving the necessary tools to the front-end personal bankers and RMs, creating the customer experience hub, and then riding on the common AI platform, which we are now going to expand to all across the bank, whether it is the front-end branch banking, whether it's for the VRM channel, and also for credit decisioning. I think we should be having a next wave in terms of productivity efficiencies. I have spoken a lot on the strategies. I think I'll leave it to Srini to talk about where we stand on the current, which I'm sure a lot of people would be very keen to know in terms of the spends, consumer spends, in terms of our retail businesses, in terms of what's happening on the wholesale and SME businesses, in terms of the collection efficiencies on the moratorium and the non-moratorium book. Let me pause out here and allow Srini to sort of get into that. Srini, can you?
Okay, yeah. First, perhaps we'll get into the momentum of the business where we see, and then we'll get to the credit at the end of after we see the momentum here. First is in terms of, if you look at the day-to-day spend, right, measured by, think about the card spend, right, which is something very important. And as you know, depending on online, offline, we have almost 40 to 50%, depending on what you measure in terms of market share. month to month to month, when you look at it, there's a tremendous pickup that is happening, and as we run right now into Unlock 4.0, where much more things are opened up in several parts of the country, there is still some selected containment issues are there, but then other than that, more or less various places things are happening, and you see that what it was getting to 30%, 40% kind of April, and then we said it was getting to 70, 75%. Right now we see 80, 85%, still not 100%, but we think October is the time frame when it coincides with various festival activities that will happen both in October and November. Two major festival events are coming. That's where we think things will overtake and get past. But at this moment, we do see robustness and things coming back to life on that front, which is on the spend. Then in terms of the loan, let's do the retail and then we go to the wholesale, right? On the retail loan side, similar story in terms of think about the momentum in disbursements, right? Which was almost a standstill in April, May. Both by our choice, the bank's choice in terms of the policy tightening to be cautious, as well as the pickup in the demand in the market, because what would people do with the loan, right? The things were almost a standstill during those months. But then slowly it did kick off and come to some kind of a semblance in June. And since then we've been seeing that they are at a level, you call it anywhere, depending on the product type, 2/3 to 80% kind of, depending on what product we are talking about, in terms of the demand, in terms of the disbursements in the retail loans area. Agri has done phenomenally well through this, both the previous crop cycle where the harvest was very good, aided by the monsoon and less impacted by the COVID phenomena, and thereby it paved the way for the new crop cycle to be done well. So the agri has come through relatively well in all of this in terms of both the demand as well as in terms of the performance of the book. So that is something very good. On the wholesale side, I put it that it was more a big kind of a differentiation that we had provided both with our strength on liquidity and capital, and which over a period of last 2 years that Shashi alluded to in terms of our digitization efforts, both the host-to-host or API-based integration that we did, it was easier for corporates to be very selective, and they did a lot of business with us. So over a period of 3 quarters, if you see, we did have a great deal of wholesale growth among the top-rated corporates and government type of entities and so on. And that to some extent continues. It can't be, that at robust 30% that they continuously grow, but fairly decent, I would say, right, in terms of how the selection has been in terms of corporates doing business with us on that front. Now getting on to this is across the spectrum. We talked about how the growth is coming back to some kind of a life. Not fully there, but we think third quarter is when we could be an event where the festival type of events that could bring that kind of a energized approach to getting back to normal. In terms of delinquency, again, we'll take it in the reverse order and go by or the credit performance more than delinquency, credit performance. Wholesale, nothing much to speak. Our book has been very top rated, and we talked about the rating 4.3 on a 10 point, and which is more or less a AA, AAA type of profile of customers, has been very good and continues to be quite good. On the SME type of book, again, we have done several stress testing that we had told you in April, and then we told you in July, and things have been better since then. When we look at, we told you about 9% in various stress models, 3 stress models we ran, and we took the middle model and we said 9%, and then the same stress we ran in July and we said that's only 4% because the rest seemed to be pretty good, because we did have a very stringent measurement criteria without any support. That was a kind of, without any support, without any mitigation by the SME, we said it's 4%. Now things are a little more better, and we seem to be doing well on that. There will be a slight blip that we can talk about, a big range that we have, but otherwise there's nothing big to talk about in terms of what that is. Now, coming to Agri, I alluded to say that it has been doing well. We believe the performance of the book is better than the prior year. As we go along this crop cycle, we need to see how it turns out. But so far, that has performed well than prior year. In terms of the retail book, our collection efficiency, let's call it collection efficiency in terms of both the check bounce and in terms of our ability to meet customers and collect. We've been percent depending on the product type, right? Depending on which product, 80 and 90% is where we have been running. Moratorium book is slightly below that, but then in the moratorium book, the post the call or the in-person meeting is making a big deal of a difference in that book to get it back to the non-moratorium book kind of level. Again, between 80 and 90% is the kind of a collection efficiency we have there, and we are confident that it will go past 90 as we go through this quarter and as we enter into October and so on in terms of that. Then the last to top it off, right, it is a common question that we all would be thinking, what does it mean in terms of the delinquency ratios or in terms of the NPAs and so on? If you look at what we did over the last 3 to 4 quarters, on an average about 1.4, right, 1.36, 38, 42, call it 1.4 round, that's where we did. And sometimes, we try to always benchmark historically in terms of how things perform through various cycles. And one of the biggest cycles that we have experienced here has been the global financial crisis, 2008-9 type of cycle. That's something that we could compare. We see that this cycle, the impact that we are seeing is much less than the cycle that we have seen there. At that time, our delinquency touched 2.08, call it 200 basis points or so, and 1.4 now, 200 then, right? So we think it is somewhere in between where it can peak, but time will tell in terms of how we perform. But at this moment, when we look at those books, both in terms of the collection efficiency and in terms of the book itself, as we entered the COVID, we talked about how our book rating, the credit rating of our customers is good 12 percentage points more than the second best when we look at the bureau reports in terms of the credit rating. And in terms of the delinquency performance, when we benchmark our portfolio to what the bureau benchmarks are, we were, if the bureau is 100, we were anywhere between 40 to 70, 0.4 to 0.7 of what the bureau was, depending on product type. So as we entered, we seem to have entered in a very good spot, and we are sustaining and continuing the momentum on that as we go through this. With that, perhaps we can stop and then maybe, Saurabh, you want to open it up for questions?
Yes. So thank you, Sashi and Srini. Sometimes we wonder if HDFC Bank is a technology company or a bank. But we can open it for questions. Operator, we can start taking.
Thank you. And in this case, everyone, your question and answer session will now begin. If you wish to ask a question, please press star 1 on your telephone. Thank you. We have the first incoming question coming from the line of Harsh Modi. Your line is open. Please go ahead now.
Hi, thanks for the call. As Saurabh said, this is very refreshingly different vision that you have laid out, Shashi, in terms of technology outcomes. In terms of when you start thinking about, let's say, 5 year out, what does it do in terms of your balance sheet size, in terms of your growth, and what kind of revenue momentum do we see as a percentage of multiple of GDP or on absolute terms, whatever you think is more appropriate? Thanks.
Thank you. See, the reason why we are doing is that it will be probably a necessity, not from anyone else, from our own servicing capability. We have been at the forefront because we have been trying to disrupt ourselves time and again over a period of time to see how we can improve upon vis-a-vis what we have. But when you scan the environment, we realize that the technology is actually pole vaulted in other sectors as against what we see in banking. So we don't want to be left out. I'm not saying that we are going to take on, but at least, no one can trip that our experience sucks. So we need to ensure that our servicing capability, the experience that our customer faces is something that we can really be proud of, or the customer will be delighted to have this kind of thing. When you think about what will this do, I think, as I said, or as we have been saying all along, and Mr. Puri has been saying all along, the market opportunity in India for financial services is very, very large. We still are an underserved, underpenetrated economy for financial services. So we have a person who has built a wonderful institution. We are inheriting a fantastic platform. Superimposed on top of it, a kind of a tech platform which will create a lot of wow experience to the customer. Intuitively should step up the pace at which we are able to fulfill the needs of our existing customers, because there will be far more intelligent sales processes, more analytical, AI-driven kind of mechanism. And two, it will also sort of help in stepping up the nibbling away of share that we have been doing from the banking system. We are not still looking at a large unbanked territory, because we believe that there is a huge amount of market opportunity in the segment that we are comfortable with, which is the middle and the upper middle income group customers from a retail individual perspective, from the micro enterprises where you have a second or a third way out, or in corporates, which Srini was mentioning, which are AA and above corporates. We still have a lot more that we can just mine. So I don't want to give a number. We have never sort of given any predictions as to what this will do. But all I can say is that it should, and that is the vision that we have internally, that it should step up the pace of market share gains much faster than what we did over the last 25 years. And this is not something that I'm trying to say. It is something that the team, along with Mr. Puri, believes, and that is why he came out in the annual report saying the best of the bank is yet to come. When he said that, he's not saying it on his own. It is something the team together, we believe that probably we are at an inflection point wherein we can step up the pedal on that. Let me leave it at that.
Thank you so much, Shashi.
Operator, can we take the second question?
The next incoming question is coming from the line of Suhail Suleiman. Your line is open. Please go ahead now.
Thank you. I wanted to find out, what's your sense of how the state banks and their competitive positioning has coped during this tough period? I mean, obviously the last sort of decade and a half, 2 decades, the bulk of the market share losses have come from them. And when you speak about the huge opportunity here that you see to step up the pace, is this taking a lot more market share from them, or is this expanding within your existing customer base and the unbanked, or is it a mixture of both?
Right. See, when you really look at it, there are very few PSU banks which are really pulling up their socks. I mean, hats off to them, really commendable for despite the kind of a structure they are working within that framework. I think some of them are displaying amazing sense of self-motivation and trying to do a lot of things which, even we would be doing. Case in point being probably a State Bank of India for sure. He is large, but I think whatever they are doing, frankly, is something that we are quite inspired with. But there is still a large portion of the banking system, especially the PSU banking system, where for whatever reason, for whatever is the structure, for whatever is the historical reasons for that, there is still, many shades below in terms of what an estate bank can do. So that's where the opportunity is. We are not, it's still, even if you look at the top few banks in the PSU stack to either retain their market share or some of them even growing their market share, there is still a 30-35% up for grabs, which means that even I don't want all the 30-35%. We just need the top 25-30% of that 35%. So there's still a reasonable amount of anywhere between a 7 to a 10%, which is our segment, which we can nibble away, and I presume we can do that much faster than what we did in the past, because we have the balance sheet size, we have the distribution now, the distribution expanding with a lot of partnerships in the semi-urban rural, which is where they are. Superimposing, as I was mentioning, in terms of our technology, in terms of our product offerings, in terms of our service offerings, and making it reasonably seamless. And I think we're reasonably confident that we can nibble away much faster. That's where the opportunity is. In rural India is going to be is a virgin market for us. We are very well positioned, and that's something that should nibble away a higher share. So our strategy is to nibble away part of that, and part of it, you're right, is mining our own internal base. We now, at the pace at which we're acquiring customers, I think we should be, touching 80 to 90 million in about 2 to 3 years' time. And with that, the penetration of our other products, whether it's a credit product or a payment product, is still very small. I wouldn't say that it will be somewhere in the late teens to mid-20s. So the opportunity to mine, and the fact of the matter is, the more and more the fact that today the amount of data that is there with us, the amount of new data that we will get when we create ecosystems, the amount of data that we have out of our merchant acquiring systems, the amount of data that we have out of our UPI systems, where we almost have a 25-30% share in terms of as being the bank handle. And when you take all this and you're now going to ride your decisioning models on an AI layer, which will be fast and quick to assimilate and get to a decision point much faster, the ability to penetrate will be to that extent much better as we go by. So I think, that is why, from a priority perspective, that is why we are focusing more on getting our this next journey in tech right, and putting a lot of energy and resources and our management time there. So, which is what gives me or gives us a lot of comfort when we say that we have reasonable amount of confidence that we should be gaining the market share, nibbling away share from the banking system much faster than what we did over the last 25 years. Thank you.
Operator, can we move on to the next one?
Yes, sorry. So next question is coming from the line of Antariksha Banerjee. Your line is open. Please go ahead now.
Yeah, hello. Good afternoon, sir. Can you hear me?
Yes, please. Good afternoon to you.
Yeah. So my question is more on the recent spate of regulations that we've seen for the sector. For instance, you have these new current account rules coming up. What's your thought on that? How will that impact the market share dynamics in the current accounts in the country? Then you have, regulatory, tussle going on between the judiciary and the regulator depending on where the profitability metrics of the industry should stand. Your views on these regulatory, the different kinds of regulatory dynamics that are playing out.
Good. See, it's not new that your regulations will continue to act as consumer activists, either for the consumers or for various different stakeholders in the system, and for whatever reason. It could be from a risk perspective, it could be from a governance perspective. As an entity, once you are in the part of the system, you have to embed whatever it is as a part of your business model. So this is not something that we have not. You go back 5 years. Every year, the bank has been impacted because of one regulation or the other. We have lost a fair amount of revenue streams or margins on distribution of insurance products, on distribution of mutual fund products, on distribution or on the debit card fees, or the merchant acquiring fees, etc., etc., etc. This is something that is a given. You will have to encounter, and regulations have a job to do. It is something that you will do, including your current account regulations. They are wanting to ensure that if there is a facility, a dominant facility, the objective is to ensure that the cash flows of that particular customer is visible to the person who has given the dominant facility. It is a very fair thing. Obviously, it goes against the fact that the customer wants to reduce his cost of operations and transactions and funding by having a very efficient transaction banking experience, which is why, where we stepped in. So we have to embed that. What do we have to do? The rules are such that there will be times when we do have a fair amount of cash management and also a reasonable share of our on the lending side. So I don't think we should have a problem. But you're right, there will be some amount of customers where we need to step up the exposures to be able to continue to enjoy the transaction bank floats. So that is, we have identified which are those kind of customers and segments. There are some which we have to give up. We have assessed the entire impact of this. We should be largely neutral, if not slightly better from where we are at this juncture. We have a clear strategy of how we can convert this into an opportunity. So that's where it is. But I'm just talking about the broad contours of all the regulations that are coming about. We cannot be sulking. We have to take it in our stride and see how we can convert this into an opportunity. And that's where we are. So,
Sure.
So the key is, it is the reason why we are stepping up the digitization, the reason why Srini is spearheading now how the cost to revenue should be gliding far downwards is not necessarily it will create a bit of a cushion to expand the ROA, but it will provide a cushion wherein you will counter and absorb all the issues that may happen from a margin perspective or from a fees perspective as an entity. Ultimately, with the unit rate margins coming down on fees and float, we have to have more and more on volumes, which means that we have to have the ability to and the scalability of our architecture to take more customers and deliver in a far more frictionless experience, because at the margin, the incremental costs should be transactions should be much, much, much lesser to be able to withstand any of these regulatory issues that will be confronting the banks in the system today. That is a game plan.
Sure.
We are quite comfortable at this stage.
So you see you foresee the top line steadily, nibbling away or declining, is it?
No, I wouldn't say, when you say top line declining, from which perspective, sorry?
No, you said that the cost decline will be offset by the margin decline so that you would not necessarily have an ROA expansion. So,
yeah, we are preparing ourselves. I mean, you never know what's going to happen. My point is, as I said, that's a bit of an unknown for all of us. But can I ensure that I'm able to absorb this? That's what we are trying to do. If it doesn't happen, we'll enjoy higher expansionary ROAs. But if it does happen, at least we have a cushion. So that's what I'm saying. As long as we are able to operate between a 1.8 to a 2% ROA for a longer period of time, which is what the reason why we are really focusing on getting our cost to earnings down, I think we should be all right to absorb any of these regulatory shocks that will keep on coming over the period of time.
Sure. Thank you so much.
The next incoming question is coming from the line of Vinit Malo. Your line is open. Please go ahead now.
Hi.
Please check if your device is on mute.
Hello, can you hear me?
Yeah, I can hear you now.
Mm-hmm. Yeah, thank you. I just wanted to, understand one thing. So, all this investment in technology, you spoke a lot about, it enables you to take over market share a little faster. You also spoke about costs coming down. So, I mean, if I were to just focus on this cost to income, what kind of trajectory, you envisage for cost to income over the next, 4 or 5 years? And the change in that ratio, I mean, do you expect it to be kind of linear in nature, or do you expect, after a point, you sort of start having an exponential sort of benefit in that, cost to income line?
Good. Sri, you want to take that?
Maybe, we'll do. Yes. See, the way you think about the cost to income coming from, call it 39, right, around it, sometimes 39.5, sometimes 38.5, call it 39. From there, which normally, while we don't provide a particular number guidance or so, what we have said consistently over the last year, 2 years, is that as a bank, we will drive this efficiency down to mid-30s over a period of 3-5 years. So that's that answers where we are trying to do. The second thing that you mentioned, whether it will be linear, it will not be linear. And quarter-to-quarter gyrations will happen here and there, depending on what sort of marketing or investments that go in. But over a period of time, that is the kind of trajectory you need to see. And then the third thing that comes is, all right, it will go to mid-30s and it will have quarterly gyrations up or down to a moderate level, but it will be generally in the direction of down. Then what will drive it? One is the efficiency, which is driven through digitization, where the marginal cost of doing something is taken down, is brought down. So that's one thing that will come. The second thing that will come is the process improvement, the changes. As we go through, and the COVID has been a good teacher from that sense, where it has demanded us to look at all the processes where there are handoffs, to go look at them to see how we need to re-engineer them to make it a little more less frictionless, less handoff, less touch points, so that it can be straight through. I'm talking about the traditional processes, right? So that's something that we are trying to do. The third one also is part of connected with the digital, but that's part of the marketing effort, part of the efforts in which we go bring the customers on to us, right? So that effort itself, we are more on to the digital side, more in terms of think about using the AI and the bots to see how we hook the customers and bring them in. And the Adobe is also another example where it makes it a little more easier for the customers to complete the journey and not fall off as we bring the customers on board. So these are the kind of things we think will bring more efficiency and get us into that kind of a spot.
Sure. Just a follow-up to that is, outside India, there's sort of this conversation about virtual banks, right? Getting that concept here in the sense that the banks who invest more in technology to get all these processes, online and direct to customers, right? And it is talked about these virtual banks could have, cost 1/10 of traditional banks. So, and you also alluded to that marginal cost is extremely low when everything is happening through this digital process. So that means that this process of your cost to income coming down, mid-30s is your target, 3 to 5 years. How long can this process continue? And that's why I wanted to understand. Is this going to become exponential? After a point.
Exponential means what you're trying to ask if 35 is the mid-30s is the floor, or it keeps going down all the way. Is that what you're talking about?
So if your business grows by, let's say, 15 to 20%, your cost to income actually sort of falls, much more significantly.
Good. But the challenge, that for a sustainable growth, right, the business needs to make investments. Both refreshments, which is refurbishing certain things that are existing, plus entering into new forays, making new investments and experimentation and those sort of things. That's the challenge. That's the challenge we will take, and we will continuously do. Make those kind of investment choices so that we make it sustainable for a longer time to come. If the horizon is 10 years, it is easier to take the cost to income to 30 or 25. But that is not the horizon. If the horizon is much more longer in terms of sustainable, how do you take this and keep going? Then you have to make those kind of choices on investments, both refurbishment investments as well as new forays. But you have to do those things and make experimentation all the time, which is what we intend to do. And we have been doing, and we will intend to continue to do that as we go along.
Can I also step in, Srini, out here? Just to add to what Srini has just said, very rightfully. See, India is a different country. Let's face it. What we are trying to put on the tech stack, you can attract a Gen X, a Gen Z, a Gen Y, whatever, the urban millennials, whatever you call, who probably would have adapted to, the virtual kind of, or the online kind of banking far more easily than a large part of the demography of India. As you know, two things you have to understand, that India is different from any other country, and probably for the next 20 years, the demography is going to be very similar. The way our people are going to be in the rural, semi-urban, even despite television, despite telephony, despite internet, you will still have a certain amount of culture where they want to know where their monies are, where, they want to see a physical outfit in terms of branches. They want to see a kind of a human touch. Probably we will do an assisted journeys for them, surely. But having said that, this is going to be, so the investments, not just in technology, but also the incremental investments in infrastructure, in expanding our footprint, distribution footprint will be there, number one. Number two, as Srini was also mentioning, whilst we are trying to create a wonderful, seamless, frictionless digital platform for a large set of customers, there will be a large set of customers who need to be patronized by the traditional methods as well, including providing their needs for any products, whether it's a credit product or an investment product or an insurance product, so be it. This is the reality of life, and we are not hoping to see a bit of a change there for a long time as a country. As long as this kind of a thought process or this kind of a demography or this culture continues, you will have to necessarily invest not only in technology but also distribution and also incremental footprint. So the only thing that we can do is that the pace at which the cost will be increasing will be much lesser than the revenue. So your question that you were asking or you were sort of searching for in terms of a massive kind of a cliff, falling off a cliff in cost to revenue, can happen if suddenly the Indian demography changes, wherein you have the rural millennia also, behaving similarly, or even the so-called conservative population in India moving into only purely online banking, then what you're saying is perfect. It will happen. But that is not something. So we have the enablement to have that kind of a possibility, but in reality, will it happen? No. You will have a guarded right now. Yeah.
Thank you. I think we'll close the call on that note, sir.
Saurabh, I just want to make one, because a lot of questions have come about on growth. In the last few quarters, why have we been growing faster? As Srini did mention, we have been, this has been probably our USP, which was demonstrated even in the global financial crisis, where we see an opportunity, we try and prepone some of our growth, which is what we did when there was a need to, when the large AAA and above corporates and some of the strategic government initiatives came forward. They wanted a bank which could sort of cater to their needs and provide liquidity support, provide refinancing opportunities. So that is what we did. So, frankly, during this entire period of pandemic, the wholesale and SME, thankfully to the government schemes, I think has kept us in good stead. Retail, on the contrary, as Srini was mentioning, we are just now, moving up in terms of the disbursals, but there's a huge amount of stock which are on the shorter duration. Mind you, we don't have a large mortgage book. Our retail is very well distributed. There are large short duration books, whether it's an auto loan, whether it's a two-wheeler loan, whether it's a personal loan. All these are short duration. Only the mortgage will have a longer door-to-door maturity. So that runoffs are happening. So going forward, you will have, even as we said, there are two indicators that we will have to look at. Whether the incremental disbursals are going beyond pre-COVID levels, which is what Srini is mentioning, and whether sequentially our growth is, the momentum is coming back. Year on year, you will have a bit of a base effect because like the GDP growth of the country, I think the 6 months are lost on that. So I think going forward, we will have to look at the sequential growth and the disbursements growth before you can start to see the year-on-year growth. I think that will give you a better indicator. I just wanted to keep that in mind because even GDP also, when you look at the GDP on an overall annual basis, it is not appropriate to look at it. We need to look at it whether the third quarter of GDP, is it better than the second quarter? And that is the way that it will give a sense of how the economy is moving up or how it is reacting. I think that is just the kind of information that I'm just trying to tell the investors because this is something that I learned yesterday when our economist was mentioning to us about the way to look at the GDP numbers going forward. This is something that Srini and I picked up, saying that this is the same thing that you have to do even from our loan growth going forward as well. Thank you.
Thank you, Sashi. Thank you, Srini. That's exactly the kind of stability in performance one has come to expect from HDFC Bank. So with that, we'll close the session. I do thank the management of HDFC Bank for joining the call and all the investors for staying on. We're well over time. Thank you for your participation. Bye.
Thank you, Saurabh. Thank you, JPM, and thank you, investors. Thank you very much.
Yeah. Bye-bye.